Good morning, and thank you for joining us. My name is Mark Salter. I'm the Executive Director for the CFA Society Minnesota. We are thrilled to have you joining us this morning, and we have a bunch of people still signing on, so pardon me if I get distracted and forget what I'm saying. Really quickly, I've got a couple of housekeeping things to do, but I mainly want to start with a couple of thank yous. First of all, I want to thank the firms that you see on your screen right now, our annual sponsors, and also CFA Institute. So really quickly, our annual sponsors are the firms that every year help us by providing thought leadership and financial resources so that we can do things like this. So we can't do what we do without them, and we really appreciate their support, as well as the support of CFA Institute. When the pandemic hit a couple of months ago, they realized that we societies might need a little help to continue delivering good content to folks like you. So they generously have provided a Zoom meetings license through for the next 12 months. So, all right, I am going to cover one housekeeping thing, and that's Q&A. If you have questions for Stuart and Joseph, please use the chat function, and we will be getting to those questions later on in the session. And I think that's the only housekeeping thing I have. I'm going to stop sharing my screen, make sure that we are recording. We are. Look at all those lovely people. And Stuart, I think, actually, I'm turning it over to Joseph first, and Joseph is going to introduce Stuart, and away we go. So thank you all for joining us once again. Appreciate it.
Perfect. Thank you so much, Mark. And thank you for having us on today. Special thank you also to Megan for helping get all the logistics in place and getting us here. I think most importantly, thank all of you for giving us an hour. And so we're hopeful that this is just going to add to the Zoom malaise that everyone is currently facing, and it's going to be an hour well spent. You know, we're nearly a half of a year into the pandemic. And so before we pivoted to our topic today, I just wanted to say that I hope everyone's healthy and staying sane on your side of the screen. Emphasis on the sane. My wife and I, we had a baby boy at the end of February. So this has been a especially challenging yet rewarding quarantine period. I'll just leave it at that. If anyone has baby tips, we could kind of swap those later on. For those that I have never had the pleasure of engaging with, my name is Joe Stellato. I'm joined by two other colleagues that are not on camera, Kristen Ross and Martina Hodges. Together, we're responsible for building all partnerships with Baillie Gifford for anything that's non-institutional in the United States. I'm in Minnesota the most frequently in a non-pandemic world, so I'm looking forward to engaging with you all, hopefully off the back of this. I'm also joined by our guest of honor. I should have probably said good afternoon to him instead of good morning, Stuart Dunbar. Stuart, he's actually connecting in from Scotland, where our firm's headquartered. He's one of our firm's 46 partners. He's actually the author of our first ever marketing campaign, especially here in the US, called Actual Investing. He presented that piece at last year's annual CFA conference in London. He was scheduled to do that again at this year's conference in Atlanta, but clearly that didn't take place. So that was really the impetus behind us reaching out to a couple of the local societies instead of doing the main stage conversation, to connect directly with a few folks directly through this venue. So hopefully you guys get a ton out of that. Stuart's planning on expanding where we're seeing opportunities amongst, honestly, all the noise and the news that we're currently facing, the barrage of every single day. Ultimately, we're going to get to what he thinks has changed or maybe hasn't changed since we've all been locked away in our houses. It's going to be more of a dialogue. Stuart's he's up front in saying that he doesn't like to just speak to folks. So Mark mentioned, please put in your Q&A through the dialogue box. We'll interrupt throughout the conversation. We'll make it as interactive as humanly possible. But before I do hand it over to Stuart, just given that this is likely the first direct engagement that many of you are having with our firm, I thought it made sense to just make a few high-level comments to help frame our discussion. All right, so our firm was founded 112 years ago in 1908. I mentioned already that we're headquartered in Edinburgh, Scotland. We're strictly an investment manager. There are no other aspects of our business. A lot of folks are surprised by the fact that we're currently managing a bit over $320 billion of clients' assets. They're surprised because this is more likely than not the first time you're hearing directly from us. And I'll get into that in a few minutes. The bulk of those $320 billion of client assets sits on the institutional side of the fence. So most of our clients are pension plans, endowment funds, foundations, folks in the intermediary side, the RIAs, the private banks, the broker-dealers, the wirehouses of the world, typically haven't heard directly from us. Our investment approach is defined by three characteristics. Right? First, we're growth managers. Stuart's going to touch on that, but we ultimately believe that investing in companies that have an exceptional opportunity to grow is the right way to invest. Second, we believe in active management. We never use any index as a sensible starting point. If you look at any of our funds, you're going to see high active shares across the entire board. And then lastly, we're long-term focused. And I think this is probably the most important point as we go through, especially looking at the pandemic and the lens of what that means to us. You know, our average hold period is around 7 to 10 years. Obviously, that's much higher than the industry and significantly longer than most of our competitors. And I always like to juxtapose that with the average CEO tenure in the United States is 4 years. And, you know, us holding companies for 4 to 7 to 10 years, a lot of times we're holding these companies for a lot longer than the people that are currently expected to lead them, which I think kind of grounds us in our discussion a bit. We attribute the ability to be able to maintain the long-term focus to the way the firm's structured, right? So we're a private partnership. I mentioned that Stuart's one of the partners of our firm. We're wholly owned by 46 partners that are all actively working at the company. We've never had an outside shareholder. We've never had a merger. We've never had an acquisition. All the growth has been fully organic. And I think that's an important point to bring out. In each of our own careers, I'm sure you could bring up a moment where M&A got distracting at the least or completely debilitating at the most. Me personally, I began my career in 2008, and I started with Lehman Brothers right out of school. So that was probably the highest order of distraction. But if you just look introspectively, what that means in terms of being able to stay focused on your day job and what that means to be able to add value to ultimately to clients. Again, we'll get into that as we go through our chat today. So how is it possible this is the first time you're hearing from a 112-year-old, $320 billion asset manager? Believe it or not, we've been in the U.S. for quite some time. We took our first client on in the U.S. in the early 80s. And if you look at our assets today, of the $320 billion, about $120 billion sits with U.S. clients. But like I said, almost all of that is on the institutional side of the house. Historically, we've been focused there. If you were an RIA or an advisor, regardless of your institution, and you wanted to access our investments prior to about 3 years ago, the only avenue to invest with us would have been through one of our sub-advised relationships. So we're most noteworthy being partnered with Vanguard. We have a partnership with SEI and Edward Jones. We're in their multi-manager solutions. So that was really the only avenue for partnership. About 3 years ago, we went through the process of launching our full mutual fund suite with the appropriate share classes that made ourselves available on all the different custodial platforms. I won't get into the how the sausage gets made on the operations side. I don't want to lose everyone in the first 5 minutes, but I'll stop there. I'm happy to take additional firm questions offline or later on. Just let me know if that's helpful. But let's bring Stuart on now. And I know he has a few prepared comments, but I thought I could make this as controversial as humanly possible for us to start out. So I was doing a bit of my my nighttime reading and looking at some of my old CFA textbooks, and I realized that reading 9 from the first level of the CFA is when they address probability distributions, and they talk about ultimately why equity returns should be normally distributed, and clearly that gets you into a conversation of CAPM, which is throughout the entire CFA curriculum, levels 1, 2, and 3, prevalent. So I thought we could start Stuart off with the very fun question of, should the CFA Institute dedicate so much time to the formula and the application? And if they should or shouldn't, you know, what do you think should be tweaked about that?
Thanks, Joe. That's a very interesting sideways starting point. First, let me just say thanks to everybody who is taking some time out to listen. Please do ask questions. Joe said I don't like to just talk. Well, the answer is I can do that, but that's not going to be what you guys want. So please do ask questions as we go along. I'm delighted to go pretty much anywhere. Okay, Joe, this is quite fun because I can kind of go halfway through my presentation, which is a good place to start. It probably underpins, we'll get to COVID in a minute, because actually I think it's relevant, but underpinning the way we go about all of our investing is, to answer your question directly, we think CAPM is absolutely no reflection of the real world and a completely wrong basis on which to consider making investment decisions. So there's a fairly clear answer. So let me expand on that. Interestingly, there is if anyone's interested, I can follow up on this. There was a professor in Madrid recently did a survey of other finance professors at prestigious universities around the world, in which he asked the question, is it ethical to continue to teach CAPM? And he got a whole bunch of mainly anonymous responses. And the gist of it was, it's only ethical if you're very clear that this is a framework and a way of thinking, but it is not something that we should try and put into practice in the real world. And there was a wonderful quote came back from someone who, not surprisingly, was anonymous, saying CAPM is like a big hammer that a bunch of children found, and now they're going around hitting everything with it with predictably dire consequences. So I guess that tells you what I think of it. So you go back to the 1970s, Farmer French, those guys are not, stupid guys. Let's not be silly about it. But they were developing an artificial model of the market that I don't think had any application in the real world back then, and certainly doesn't have any application in the real world now. So the assumptions, and the one that you mentioned in particular of a normal distribution within stock returns, is catastrophically wrong. So if you look at this slide that I have put up here, I did say we're jumping in the middle. Our firm does a lot of, we're not really interested in what brokers have to say because they say it to everyone, and it's not particularly a source of competitive edge, I don't think. We are very interested in working with academics and scientists and entrepreneurs that give us a sense of what's going on in the real world rather than the financial world, because as we'll talk about, that's what we like to focus on. Now, one of those academics we work with is a guy called Professor Hank Bessenbinder, who is at State University of Arizona. Now, he did some work long before we even knew he existed on the structure of stock market returns. And what he came up with was astonishing. So the slide you have in front of you is actually a second study that we sponsored him to do. His original study was very similar. He analyzed the creation of wealth on initially the US stock market from 1925 to 2016, and assessed for the lifetime existence of stocks on the stock market, including dividends and everything else, what was the total returns attributable to each one, and where was the wealth created. And he came up with this truly stunning statistic that 4% of listed companies over that very long time period accounted for the entirety of wealth creation in the stock market. So that's your investment returns all came from 4% of the best performing companies. Now, just to be clear, that doesn't mean that the other 96% of companies all didn't do anything. It just means that if you take them all, some went up, some went down, they netted off over that entire time period collectively to the same return as a US T-bill. Now, we found this fascinating when we became aware of this research, because it much better describes our empirical experience of how investing works in practice. We had always known that our returns for clients, and I'm pleased and humble to say that we've done pretty well for clients over the years, hugely came from a small number of stocks which we got enormously right and which returned large multiples of our initial investments for clients. So we liked the story that Prof. Bessenbinder came up with, and we asked them to go and see whether this same structure of returns applied both more recently and globally rather than just the US market. And that brings us to the slide which is in front of us now. And it basically tells you the same story, so I won't dwell on it other than to say, in a global and more recent context, that concentration of returns is actually yet more concentrated than the previous study. So in this case, I think it's 1.2% of all of the companies listed all around the world from 1990 to 2018 contributed, actually accounted for all of the gain in the stock market. 0.2% of the companies accounted for half of the gain in the stock market. Now, we think that's a fairly startling statistic. And to go back to Joe's question, almost nothing could be more different from the idea that there's a normal distribution of stocks. So what does that mean for the task of investing? It means that you can do one of two things. You can buy a passive fund, and you will own the small number of stocks that are huge multipliers of your investments, and you'll get an index return, clearly. Or if you believe that you can do a decent job of zooming in on the small number of companies that have a chance of being truly outstandingly successful, then that should inform the way you go about your research process, the level of uncertainty you're happy to invest with, how you spend your research budget, who you talk to, and actually the nature of the portfolios that you invest. You don't want to have a whole lot of stocks. You want to have a relatively concentrated portfolio in which you know from the outset that you will have some big winners and actually some total failures, because that's the nature of investing in extreme growth. So that is a jump in the middle. Let me just show you that slide, which we can come back to if anyone's interested. We show this to clients because it's our worst ever investments and our best ever investments for one of our most growthy, long-standing strategies. And you may think it's peculiar to show our worst ever investments, but what we're trying to demonstrate here is the poor ones are relatively insignificant because essentially you can only lose your money once. The good ones, we can make literally 30, 40, 50 or 60 times our money by running those winners, as long as we remain confident about what those stocks are going to do. So that's a long answer to a simple question, but I think it's probably relevant as we talk a little bit more about, bring things a little more up to date in this sort of what's happening in our post-COVID world. So if you'll allow me, I'll just talk for another 5 or maybe 10 minutes, and that hopefully will stimulate some questions and some conversation and be more directly on topic. So I think, needless to say, the past few months have been fascinating for all sorts of good and not so good reasons. But if we limit our conversation here to what have we learned from a investment point of view, we already know that profound change takes place in the real world. I'm not talking here about the stock market. I'm talking about the real world that we live our lives in which we consume things and buy goods and interact with each other. Things change dramatically as technology changes. Now, something that has not changed due to COVID is we were already on the way to online shopping and video conferencing and home food delivery and alternative approaches to healthcare and a whole bunch of other stuff that we can talk about. So the world is not, in fact, turned upside down. The world has just overcome the pain of adoption to some of these newer ways of going about living our lives. Now, that's a really interesting thing because depending on exactly what you're talking about, we've probably seen 5 to 10 years worth of change in some of these areas take place in a 3 or 4 month period. So obvious things like here we are on Zoom. I think Zoom is now running at something like 15 times the number of daily users that it had back in January. Clearly the share price has responded to that. There are various other ways in which we're now living our lives differently. I think consumer shopping has gone from 16% online to 27% online and is rapidly growing still during this period of COVID. The key point here is not the world has changed, it's simply that the disruption has been brought forward. Now, in our firm, we've benefited from this because our approach to investing has always been to take a 5 to 10 year view of the big things that we can foresee are going to change in the world, to be happy with the uncertainty that comes of trying to get in front of some of this. We often say we think it's easier to forecast what's going to happen over 10 years than 2 years. And all of that stands true. It's just that In fact, to be honest, it's more of a worrying thing than something to be pleased about. Is a lot of that has happened much faster than we anticipated. So our task now is to consider whether these companies that have benefited from our changed way of living, everything from Amazon to Zoom to Chinese food delivery to some of the smaller healthcare names that have had very strong performance this year, do we still think they can double from here or more than double? And the answer in most cases is yes, because although the market has hugely bid up some of these names, they're still only looking 2 years out, which is pretty typical and about as far as most people go. Just to take a step sideways for a minute, we've done a lot of analysis on the length of time over which you can safely ignore the stock market. Now, that might seem like a strange thing to say, so let me elaborate. But we're actually not that interested in the stock market. We're interested in companies. Now, the basis on which we invest, and we know this to be true, on a 5-year view, the companies that have, the quintile of companies that has the fastest earnings growth is also the quintile of companies on average that has the best share price performance. That relationship holds true across markets and across time periods for rolling 5-year periods, just about everywhere. What that tells you is if you have a 5-year plus investment horizon and you organize your incentives and you talk to your clients in order to think in those time scales, you can afford to focus entirely on the operational aspects of the companies in which you're investing in, safe in the knowledge that the share price will eventually catch up. So if you invest in that top quintile of growth companies, you will outperform the market on a 5-year plus view, provided that you do a decent job of it. A couple of other things to just pick up on, I guess. The pattern of returns in the markets this year has not been what you would have expected for an abrupt slowdown. And I think what this reflects is the value now of companies is very largely attributable to intangibles in a way that didn't used to be the case. So it used to be, if we go into a very sharp downturn, companies with high book values and high tangible values are somewhat protected because they have value of physical assets. But in this case, the growth versus value argument, as people traditionally understand it, has worked exactly the other way around. So growth companies have clearly done particularly well during this very abrupt downturn. And I think that's because, as I said, the value is now in network effects for digital companies. It's actually an R&D spend for companies that are continuing to invest in their own future. We maybe touch on that. Very few companies are now investing adequately in future revenue growth. So an awful lot of companies that look like their value are actually just in secular decline. Things like management culture, obviously intellectual property, these things are all now far more important than they used to be in a world where tangible value was the sort of backstop for valuations in a downturn. So I think we're seeing something very different, and it reflects the speed of disruption that now exists in some of these areas of the market that I mentioned. Let me just scroll down to, we'll skip that one and that one. I might come back to those, but let me just show you this one. This is what I'm talking about, companies not adequately investing in their own future. So this almost, 25, 30 years of history shows how the decline in companies investing in future revenue growth over the 30 years. And basically, if you use growth capex and R&D as a proxy for investing in the future growth of your company, and you use buybacks and dividends as a proxy for spraying money back to your shareholders. Now, to be clear, that's not necessarily a bad thing. It's the balance that's important. But what we have seen here is a decline in growth capex of about 80% in the last 30 years. Now, I would suggest to you that that means that the bulk of companies now are hugely underinvesting in their own future. It's actually worse than it looks, even based on this chart, because the R&D spend that now does exist is overwhelmingly in a small number of large companies that have got the right management culture and timescales in which to try and enter new areas of the market. So just to try and make this less abstract, I'll give you a really obvious example. We've been investors in Amazon since 2004. Clearly, we've done very well out of that, but that's actually not my point. My point is Amazon has been reinvesting in its business furiously for virtually its entire existence. And that's what's led it to have things like Amazon Web Services is a fantastic business. Clearly, its online business is working well, and they're expanding into all sorts of other areas that may or may not work, like, driverless cars, all sorts of stuff. We like companies that are trying to continually disrupt the sleepy incumbents that we think have really suffered through this sort of 6 months of sharp downturn. So that's just a long way of saying I think the world is a very different place than it was 10 or 15 years ago, and what COVID has done is really just brought that into sharp focus for everybody. What else should I say before I'll come back to Joe in a minute.
Can I hop in really quick and just maybe ask you to focus on one point that you made? So you highlighted a couple of times how we focus on strong management teams. The idea that we look for leaders that aren't making decisions based necessarily on a quarterly stock price, but able to think more longer term. So I guess that brings up two questions. It's two-parter. So firstly, how do we balance long-term profitability with the next 5-year runway, right? So if someone invests in one of our funds, are we investing in companies that we think could be profitable 10 years from now? Or are we able to invest in companies that are going to hit that bogey, if you will, in the next 5 years, right? We're in the press all the time for Tesla, but that leads into the conversation about SpaceX, and SpaceX clearly being on the further end of that long-term spectrum. So that's the first question. And then the second question is, how do we engage with management teams, right? And especially during a pandemic, how has that been different versus how some of our peers might have been engaging with management teams going through potential short-term profitability or choppiness? I'll stop and let you touch on both.
Yeah, okay. So on the first one, the quick answer is that 5-year analysis that I spoke about. So as long as your horizon is that long, the share price performance of the companies we're investing in, regardless of starting point. So even if that started now, I have a high degree of confidence that as long as we are correctly continuing to identify the top quintile of future 5 years growers, which clearly we think we are, many of them are the same companies. Just because they've grown rapidly doesn't mean they will stop growing rapidly. You can be safe in the knowledge that if you have that 5-year horizon, you will perform over that time period. It is interesting, though, that you have to distinguish between the horizon over which we expect a company to be very profitable and the horizon over which we expect the market to realize that a company is going to be very profitable. And those are not necessarily the same thing. So if you take the SpaceX example, I mean, I really don't know, but I have my doubts that SpaceX will be massively profitable in 5 years' time. But I think the market might have worked out that SpaceX is going to be fantastically profitable in 5 years' time, even if the profitability doesn't arrive until 5 years after that. So that's simple things like, for those, I don't know how well people know SpaceX, but it's probably a good example of embracing uncertainty. So there are obvious things at SpaceX, like the NASA and the US government will pay them to take astronauts up to the space station. So they've cracked that. They can do that in a semi-profitable way. You've then got Starlink, which is they are in the middle of deploying what, all being well, will be a global low, a near-Earth satellite constellation for global broadband through satellite. For those of you who care, satellite broadband doesn't work very well at the moment because you need a small number of geostationary satellites which have to orbit at something like 24,000 miles out. If instead of that you put in place a whole constellation of near-Earth satellites, your ping rates come down, you can make satellite broadband work in a way that it hasn't done historically. Tesla has a real chance of having a system like that in place within about 5 years. And suddenly you've got global domination of the broadband market. Now, what's that worth? Go figure. But did I say Tesla? I meant SpaceX. That's a wonderful opportunity in itself, which is definitely not reflected in any current valuation of SpaceX. And then on top of that, just ask yourself the question, if the cost of sending stuff into space, satellites or whatever else, reduces by 90%, which is kind of where SpaceX is going, what other commercial ventures does that make possible that simply were not possible when the costs were 10 times higher? Now, we don't know the answer to that, but we do know that entrepreneurs are smart people, and many, many things will become possible that aren't currently possible, and SpaceX will be in pole position to benefit from that. So that's just an example of saying, can you put a spot multiple on that? No, of course you can't. This is one of the great fallacies of investing is the illusion of certainty. We can't have any sort of certainty around all of that, but we can say that in 10 years' time, we can see all number of possibilities. So SpaceX could be 10, 20, 30 times the size of company it is today in terms of market cap and profitability. Now, the second point you asked, Joe, was about engagement in companies. So I think this is an interesting one too. To answer your question, we wrote to the bulk of the holdings in which we are large investors. We run pretty concentrated portfolios, so we do have big holdings in some companies. We wrote to management asking them at the onset, when it became clear that COVID-19 was not just a sort of medical challenge, but actually a major problem for society. We wrote to the management of companies encouraging them to disregard short-term profitability and certainly to move away from any notions of quarter-on-quarter targets, for example. We asked them to treat their staff well. We asked them to treat their suppliers well. We asked them to put the safety of all concerned first, and we told them we don't mind very much. We really don't mind very much at all if you become unprofitable for a period of time. And the reason we did that is not because we're, some kind of evangelists, crusaders or something for doing the right thing, although I don't think that's entirely irrelevant. But it was a much harder-nosed investment decision, which is we firmly believe that the companies that treat their people well, treat their customers well, and do the right thing during this period will benefit in two ways in future. They will benefit from being the companies that a more discerning consumer and client base wish to do business with. And I think that's becoming more and more important. We can talk about ESG more generally if of interest. And the second part of that is we do live in a world in which governance is increasingly important. By coincidence, the slide that I've left on the page here talks about the power of different levels of change. So at one end, fashion changes all the time. It doesn't really have much power to change anything in the world. Nature changes very slowly, but can change everything, as we have just discovered to our cost. And I think sort of carbon and climate change is another one that fits into that category. Anyway, we think that the companies that are doing the right thing in the long term are likely to be those that will attract the business of their customers in the future. We think governments in particular, this is the point on governance, governments in particular will clamp down quite hard on companies that did not do the right thing during a period of social pandemic and social challenge. So for that reason, we've encouraged everybody we invest in to take the longer view and to try and make sure they're playing their part in society actually through this whole COVID period. And as I say, that I think is likely to stand us in good stead for future investment returns. I can talk more. I don't know if there's more questions. I can talk more about this pace layers thing, Joe, but I'll come back to you just in case there's anything else first.
No, I would remind everyone, if you do have questions, please use the chat feature. We have nothing in the queue now. So Stuart, I think you can go there, and then I have a couple of questions that are top of mind for me too, but please go into the pace layering.
Okay, I think this is interesting. So for anyone who doesn't know, Stuart Brand was the co-founder of the Long Now Foundation, which are famous for their 10,000 year clock. And what that's all about is trying to get people to think about the real impact of change, if you like, and trying to put in context that the things that we think are important often turn out not to be. Anyway, the pace layers was originally a concept which was used to describe how buildings evolve over time, and very simply that, you don't need to change the walls, but you do need to change the fixtures type stuff. But this has all been now converted into, I think, this interesting way of trying to understand companies, and particularly interesting in the context of some of the now controversial companies, such as in the US, Facebook, less controversial, but in China, Tencent, Google, possibly Amazon, in which there are a small number of companies now that have grown to the point of dominance, where it seems very hard to see how they're going to be knocked off of their position of dominance. How does another Amazon get started when it has Amazon to compete with? So these companies are becoming infrastructure rather than business. And if you look at the layers on the slide, once a company becomes infrastructure, the thing that we have to worry about as investors is no longer the sort of traditional competition type of issues, but actually governance, the next layer up. So we've spent a lot of time thinking of late about, do Facebook's goals align with society's goals in the US and globally? And some would argue that not particularly, so that undermines the investment case for Facebook. Having said that, they clearly are by far the most effective way for advertisers to operate now. So sort of offsetting features there. Tencent is an interesting example. For those who don't know, Tencent is a sort of combination of, it's like Facebook, but way more. In China, people basically live their lives digitally on Tencent. You can do everything on it, from booking your driving test to getting your medicine and paying your friends. It's very much aligned with the Chinese government. So you may have some interesting questions around the sort of ethics of it, but the Chinese government love Tencent because basically it's an operating infrastructure for a country with 900 million users and 1.2 billion population, which allows them to understand what's going on in their country. And before we all jump on that as necessarily being a bad thing, one of the ways, China has arguably dealt with COVID really very effectively, and one of the ways it's done that, we have an office in Shanghai, and I talk to the guys there all the time. They have built a track and trace system on the back of Tencent that nothing else in the world has rivaled. And they've had it for months because they do have this capability to work alongside government and have become infrastructure in China. So maybe a little bit of a sideways part of the discussion here, but I think it's worth sharing, just in the sense that the idea that you've now got these potentially unstoppable companies which are described as FANGs or tech, I don't think that's actually the accurate way to describe them. What you have is some companies that have installed themselves in global infrastructure and could continue to grow to multiples of their current size because they have become the way that people live their daily lives now.
Perfect. So we actually did get a couple of questions that filtered in as you were going through that. To answer the question, I'm going to follow up with everyone that's on the call as soon as I get the attendee list with the slides from today. So we'll make them available for everyone. There was one question that came in about the future of FANG stocks, but you touched on that quite a bit just now. This one's a little bit more provocative, and so I'll soften it and kind of tie it into the pandemic a bit. It's around just simply value versus growth, right? Is value debt? Is what the individual just asks. Just put simply, growth has outperformed over the past decade. Clearly, it's performed admirably throughout the pandemic here. So I guess part one is value now dead? Should we declare it? And then two, as a potential second wave, whatever that may or may not look like of the pandemic comes through and looms from the future, how should equity investors position that? Things change so quickly on the first wave. Will they change again? And does that open up an avenue for value stocks?
Yeah, okay. I think I'm not going to avoid the question, but I will start by saying I think it's dangerous to actually categorize growth and value in the way that we traditionally have done so. It comes back a little bit to the discussion of how concentrated returns in the market actually are. So we call ourselves a growth manager, but if anyone wants to go and read what we mean by that, there is actually a bit on our website which we particularly talk about growth versus value. And we say on it, we call ourselves growth, but it's what we mean is far more important. Now, what we mean by growth is seeking those exceptional companies. So we're not thinking about the companies, the market is not 50% growth, 50% value, or however some of the index providers care to try and categorize it. A far more useful way of thinking about it, in our view, is where is real world growth coming from? So as opposed to looking at the way some of these index providers work is they look at various financial metrics and almost reverse out. If you don't have these growth characteristics in your financial metrics, you are a value company. I don't really think that gets you anywhere. I think the vast bulk of growth is very concentrated in a small number of companies. So that's what we should be talking about. Now, that does relate to the question of, is value dead? Now, I guess the starting point here is never be overconfident. So growth has now vastly outperformed value for about 12 years. And you have to argue that that's a long enough period of time to make us question ourselves as to whether something has changed. So there's a lot of academic evidence that say in the very long run, value outperforms growth. And that's largely because we have lived in a world of, well, I said that's not right. I don't think we ever have, because people used to think we lived in a world of mean reversion and they would invest on the basis of mean reversion. And often that would prove to be the case. So you can buy a company which has had a piece of bad news, the share price has overreacted, it's below some notional measure of its intrinsic value, whether that's book value or whatever you care to use, and you would expect it to mean revert because people have overreacted to bad news. Now, that still does happen. I think it's just a lot harder now, because the bad news that is coming out in respect of some longer standing companies tends to relate around the fact that they are being completely disrupted out of business. And if that's the case, it's far more common for that to be the case. And that being the case, a far smaller proportion of what appear to be oversold companies in share price terms are not actually over responding to bad news. If anything, they're under responding to bad news because many of these companies are going to be completely disrupted out of existence. So that's happening a lot faster than it used to. That's simply the opposite side of talking about the vast bulk of growth accruing to a very small number of companies. That growth is coming at the expense of other companies that are not adaptable and not disrupting enough to maintain the market share. And that in turn links back to the lack of spending in R&D that we're talking about. So I think there are good reasons that it's proven to be very challenging to be a value investor in the last decade or so. Let's be fair though. I don't think value managers are not like a bunch of stupid people. They can certainly adapt their approach. Now, I've not really seen this done very well, but there must be scope to better understand the intrinsic value of things like brand and network effects and IP and culture and all of those kind of softer stuff, because people do understand that that's important in business now. But it's just that I don't think anyone has really fully updated the mental model that we're using for the traditional value approach. So for instance, I know some value guys have bought Facebook, and you kind of think, how does that make sense? But the argument there is it could make sense because you can see a fairly clear path now for Facebook to continue to monetize. It's got something like 60 million companies have a presence on Facebook, but only 6 million of them pay money to advertise. So that 6 moves something much closer to 60 over a period of time. That's quite visible. You can discount that back to today and you can come to the view that Facebook is therefore a value company. So people are, I think, attempting to change the way they do value. So I wouldn't want to, the answer is value as was, I don't think reflects the real world anymore. And no, I don't think it's coming back. But I think it would be wrong and unfair to say that value as a concept is no longer valid. It just has to be modernized. I think that's probably the kindest answer.
So this is actually one that I've never heard. Maybe you have, Stuart, and this gets into what your initial comments on Bessenbinder and his research touched on, the question from Jason around wealth creation. And so ultimately, it seems that type of research would have a bias towards the largest end of the market cap, right? He uses the example that 150% return on $1 billion market cap stock would be roughly the same as a 1.5% return on $100 billion market cap stock. And so clearly it puts a ton of the weight on the mega caps and the larger caps of the world. So his question gets to, how do we project multiple growth for that segment of the market, say 10 years out?
Okay, we'll maybe have a second bite at this because I'm not sure I've got it right. I'm not sure I might not understand the question, but let's give it a go. The way that Bessenbinder has done this analysis is lifetime presence on the market. So it's wealth creation. It's not percentage returns on whichever company it might be. So if your small company, if your $1 billion company doubles in value, that's only counting as $1 billion towards wealth creation, whereby your $100 billion company doubles in value, it's counting as that 100 billion. So the real question becomes, how early did you get into that company, I think? And there's some interesting discussions around there about the fact that winners tend to continue to win. So there's a whole bunch of stuff there about, in the portfolios we run, we have really interesting conversations with clients about portfolios doubled, it must be twice as expensive. And in actual fact, they really scratch their heads when we say the portfolio's doubled, but it's much cheaper now, because it all depends on how the share price compares to your probabilities of future earnings. So I'm not sure that really answers that question, but it's an attempt to answer it. And then on the valuation side, I think the question was, how do you think about a multiple now for something 10 years out? I think the answer is you don't try and do it with any fake degree of certainty. So what we do is we look at the probability weighted scenarios, and that includes, we do go into detail obviously, but so it includes things like not just, how big is the market and how many people might buy this product. It's more how defensible is the competitive moat for some of these companies. How will that allow them to price? Will their margins be worthwhile ultimately? I mean, that's kind of a golden question, because there is such a thing as profitless growth, and that's not good growth. It doesn't need to be profits now, but we do have to see a way to having worthwhile margins in some kind of reasonable time frame. So we think about it in that framework. It does mean that, for a company in which, we think they can, let's just say, grow at a pretty fast growing company. If a company grows sustainably at 20% per annum, okay, it's doubling every 3.5 years. Would you pay 25 times for that company now? We would, if we thought it could double 3 times, because then you'd only be paying 6 times for that company 10 years down the line. And if it was still growing, clearly it would be on a much higher multiple at that point. So we don't try and create precision. We try and invest in companies where the starting spot multiple is really not that important relative to where we think the company can get to. There are other investors out there who will, this company's on 14 and its industry peers are on 16, so we think it's undervalued, we'll buy it and wait till it goes up 15%. And, great if you can do that, but we actually think that's an incredibly risky way to invest, because you don't have a high degree of confidence that that's going to right itself. Whereas conversely, we think there are companies where you can have a high degree of confidence that they'll double their earnings 3 times in 10 years. Tesla is the classic example of that. I think I read something recently that Tesla's had 6 doublings since launch. So what appears to be infinitesimal growth goes through that exponential thing. And once you've got 8 doublings, Tesla has 2.5% of global market share. It's on 6 at the moment. So it's just trying to think about it that way. So that almost means when we first bought Tesla 10 years ago, I don't even know what valuation it was. It was probably an infinite valuation because it didn't make any money. But does that matter? Not really. You have to think about where might this company get to.
So on that point, and I hope I understand this question correctly. Someone wrote in asking about, we're investing in mid to long term, the mid to long term future of some of the companies that we're working with. We're focusing clearly on CapEx and R&D. Are we ignoring brand investments? I think what they mean by that is, brand recognition and, advertisement and building up a loyalty. I think you talked a little bit about this with the layering piece, but maybe you just want to address on how that kind of works into the overall equation for us.
Yeah, the answer might be yes, actually, although, so it's a fairly crude metric. It would be an even more extreme metric if you counted brand spend as CapEx. And actually, I think some companies have kind of started to do that, but genuinely it's for the wrong reasons rather than the right reasons. It's in order to inflate, normally you would expense brand spending. Some companies might call it capital expenditure, and there's a theoretical reason that makes sense based on everything we've been talking about, because building a strong brand has huge value in the world that we now live in, particularly the digital world. So yeah, I think it's a sort of interesting point. We haven't included that in our thinking about that chart that showed CapEx is a more traditional level of what companies themselves define as CapEx and R&D, and most companies won't include branded spend in that. But if they did, it would actually just exaggerate the. I think it would exaggerate the change in how CapEx has been spent. It sort of comes back. So you might say, so CapEx spending would be higher, so the chart would be less abrupt. But if you're looking at a sort of value world of tangible value, it would actually, it would change that dynamic. It shifts more of the value into the intangible, and probably means you have to analyze the company in a different way. If you think about brand spend as CapEx, I don't know. That's not a very good answer. I think it's a really good point. Actually, it's one of those to go away and think about it. But the simple part of it is, I guess I agree the underlying assumption here, which is brand as capital is something that's changed quite a lot over time, and we have to try and get our heads around that a bit compared to, a more traditional approach to looking at companies.
This is probably the sixth time that we've had a conversation like this for a regional society, and this is the first time that I've seen us walk away with a couple other things to be considered. So I think kudos to CFA Minnesota on that.
I've not had that question before, actually, which in hindsight seems like a glaring omission, doesn't it? So I'm going to go away and think about that. But so it's a, yeah, it'd be interesting to go and do an exercise and see. Companies typically will value brand in an acquisition, and then they'll write it off over a period of time out of their Goodwill account or whatever. Maybe that's different now. Maybe brand values go up rather than down. I don't know. It's a really interesting area to go and look at. It certainly supports the idea that the value versus growth discussion has completely changed.
And you have to think, I mean, not to give you more to consider, but you have to think that at least weighs in somewhat to the path to getting to the infrastructure stage of a company.
Yeah, I think, yeah. So a big part of that is, what's Amazon brand worth? If it's not actually a case of, I'll go to either Amazon or another Amazon, because there isn't another Amazon. So in that case, how do you think about the brand value? The brand is, and it's an entrenched infrastructure, which is really quite conceptually interesting.
Yeah. So we've touched a couple of times on things that we don't focus a ton on in our research, whether that be, earnings forecasts or, sell side research, or now brand investments or things of that nature. But maybe we can touch on, especially as we're all in this new world of being locked away in our houses and everyone's trying to struggle with the idea of remotely doing their own research, right? We've kind of had a little bit of a head start, given that we've always been headquartered in Scotland. We don't have research teams broadly spread around the country, right? So we've always been somewhat remotely connected. So maybe anything that you think that we've learned from that, and ultimately, how are we finding new ways to do our research and promoting our investment teams?
Quite a few of our investment teams have told me that they think they're much more productive now. I think there's timescales around this. So time to think is really important, and we've always thought that in our firm. So the way that we ask we don't divide between analysts and portfolio managers. Everyone's basically a researcher. I actually prefer to describe everything we do as research, because it's not investment in the way that most people would think about it. It's meaningful company and technology and scientific research which leads us to investment decisions. We tend to let people, even in normal times, pursue their interests rather than give them a segment of the market to look at. We don't have an Italian banking analyst. That would be the worst job in the world, because you'd never invest in any Italian banks. So to us, it's not been that big a change, because people can pursue their interests at home in the same way that they do when they're in the office. It's a lot about reading. Funnily enough, we've had pretty good access to corporate management, because they're not traveling around the world in the way that, we all have done historically. there's a whole lot of dead time involved in that. We've actually found it much easier to get a hold of some of the, our view on relationships with companies is we should make them constructive. We should be having, we only invest in the first place in companies where we think management is high quality and aligned with our long-term interests, and then we try and work with them and encourage them to do the right thing. And we've actually found the ability to have those types of conversations with management has probably been better during lockdown than it is when they are more traditionally running about the world doing whatever chief execs do. The other thing, probably, we have a lot of, it might be worth touching here on, so this slide, which may not be all that visible, just reflects some of these academic relationships we have. And so through lockdown, we've been able to continue to have discussions with some really interesting people, particularly, I guess health has been really interesting for obvious reasons. It's an area we've been very interested in anyway, but some of these academic relationships, particularly, we've got one in China with Tsinghua University where they're doing some work on genomics and gene sequencing and artificial intelligence as a diagnosis tool. We can continue to do a lot of thinking and working and discovery around what's becoming possible. All of that work in the main is still happening and has not really been impacted by, we're all working from home, because that wasn't something that took place in the office anyway. I mentioned earlier though about timescales. I think what we need to guard against, I think everybody needs to guard against this, is the idea that, well, actually everything's fine because we're very productive at home and nobody ever needs to gather in an office anymore. I don't think this is observable yet, but I'm fairly sure that the lack of serendipity becomes a problem in the medium term. I think if we don't, we might, I'm almost certain, in fact, we've now learned how to work remotely, so there will be more remote working. But equally, the passing chat at the desk or the impromptu meeting about a company or some other relevant technological development, I think that stuff matters actually to staying ahead of what's becoming possible, and therefore, given our growth style, finding really interesting companies at an early stage. So I don't think it's that we can't do that, but I think if we have to not, I think of the office as a gathering place rather than a place of work. And I think it's important that we continue to have the gathering place, because I think that's where some really interesting ideas come out of conversations.
Perfect. We've got about a minute left, so I think that's a pretty sensible place for us to put the pin and halt the conversation for now. As I mentioned up front, I'm going to be in Minnesota whenever we do move past this pandemic. I will be there quite frequently. There were a few folks that wrote in and we didn't get to answer some of the questions. So I'll send over the slides and introduce myself through email. Please feel free to engage with us. We'd love to learn a little bit more about how you all operate. And if there's an opportunity for partnership, we're happy to take it that direction too. But for now, thank you all for your attention, for coming on today. Everyone's questions were great, and we really do appreciate it. Stay safe, everybody. Thank you.
Hey, before we go, I want to.
Sorry, Mark.
That's okay. Yeah, this is Mark again. Just wanted to jump in and thank you, Joseph. Thank you, Stuart. Two things. Number one, if you signed on today with a phone number, it may be difficult for us to track down your how to get you the slide deck. So if you've got any worries about being able to get a copy of the deck, please send one of us at CFA an email and let us know. Number two, Stuart and Joseph, I actually am not surprised that you got a question that you've never heard before, because if folks here who know about Prairie Home Companion, the tagline is ends with, and all the children are above average. So we've got an above average society here, and I'm glad, Renee, that you showed that off in good fashion today. Anyway, we've recorded the session. We'll work on getting the recording out to folks as well. So in the meantime, thank you all for joining, and stay safe, stay healthy, and stay home. Take care.